Hi, you're here with Lynn and Matt from Upstart, and we're happy to have Kelvin from the CBA on the podcast today with Leaders in Lending. Kelvin, would you want to introduce yourself to our listeners?
Sure. Thanks so much, Lynn. And listeners that are on video, just be warned, I thought that this was a podcast, not a video podcast, which is why I'm dressed the way that I am. So I recently joined the Consumer Bankers Association about 5 months ago to help coordinate the policy work that we do. And so, we have a new CEO, Lindsay Johnson, that y'all interviewed last February. And, one of the things that, among the changes that Lindsay made, which I was super excited about, was she took our regulatory team, our lobbyists, our communications function, and a new data function and put them into one squad with the kind of recognition that advocacy these days has to go across those different channels. And prior to this, I was at Barclays in the U.S. Consumer Bank, where I was in the ExCo. I was briefly there leading the reg relations and policy function. I was at Capital One, where I led the bank regulatory and policy team for several years. And then I had roles at the Federal Reserve Board, the CFPB, and the Federal Trade Commission. And then I was a litigator in New York for several years.
Oh, wow. So you've had quite a great experience.
Yeah,
You're like industry, regulators, government, litigation, so a little bit of everything.
My 11-year-old's very worried that I can't keep a job. And I keep telling him that these are like progressives, but it's like, this is like the new economy, but he's very old school.
Yeah, always interested in banking, or how did you get into the CBA?
The progressively more into banking. So basically everything after CFPB was banking.
Yeah, so CFPB, very topical. We had Director Chopra.
We did
today.
We did.
What were your thoughts on his speech, his remarks, and maybe tie that back to your experience at the CFPB?
Sure. I have to start by saying I love the CFPB, right? So I was part of the kind of first generation of CFPBers, as was Rohit Chopra, right?
Oh, so you were there when Cordray. We're both from Ohio. Cordray,
Oh, there you go.
guys,
That's
so,
right.
Yeah.
That's right.
I actually, before Upstart, met through politics. So,
Oh my gosh.
yeah, small
Yeah.
world.
Yeah, but that's right. So I did my time at the Bureau under Rich Cordray, and I am and continue to be a true believer of the CFPB. I did more all-nighters at the CFPB than I did in several years in private practice in New York. But Lindsay recently testified at a hearing on the Hill where the focus was the politicization of financial services regulation. And so as part of the windup for that, we sat down with a reporter and they said, well, gosh, isn't all regulation politicized? What does this mean, right? How have things changed? And it was a good moment to kind of stop and say, oh, how have things changed? And what I would say is that back in my day, under Director Cordray, you would focus on facts. You had a bunch of research economists, you had market analysts, and the facts were the facts. And you'd set out kind of a good understanding of the market, and you'd lay out a menu of policy options, and then the director would choose from those policy options, and politics would have to play, because he'd have to figure out what would work and what wouldn't work. Then you write a headline, and you go to market. Now, from the outside in, and understanding that I'm on the outside now, it feels like the agency is starting with the headline and then working backwards, right? So you have an administration that is fixated on junk fees, and they recognize that among the electoral messaging, junk fees are one of the few things that sticks. So then that message goes down to the team saying, okay, give me some policies that you can sell politically. And so picking on big banks is something that politically sells. Then you back up into that and say, okay, then what will be the policy interventions? And then perhaps most concerningly, then you choose your facts. And so, one of the things, and I can go on for 30 minutes about this, but that we've been kind of really just very concerned about are just the facts that are coming out of the Bureau. So the director today talked about competition in the credit card market. And there's this notion that the credit card market is not competitive. And this is pervasive, right? This is why they justify their late fees rulemaking. This is why people talk about credit card interchange. And the thing I would note is that, one, there are 4,000 issuers in the credit card market. You guys know this better than your listeners know this better than anyone else. The director talked about concentration of the 12 largest issuers. I can't imagine any industry that has 12 of anything, right? 12 leading airlines, 12 leading computer manufacturers, 12 leading cell phone manufacturers. But there were also $50 billion in balance transfers, all using CFPB data. And then I'll just do a little bit more on this, then I'll stop, just because I get really fired up about credit cards. The director also talked about how consumers are apparently faring more poorly under credit cards. And they talk about super high interest rates. But in the speech today, he repeated something that they'd said in their data before, where they said that the amount of subprime cardholders has remained consistent. And that's simply not true. If you look at the CFPB's own Card Act data, the number of subprime cardholders has gone up from 62, the percentage of people that are in the subprime space that have credit cards has increased about basically 10% from 2015 to 2022. But then in the deep subprime space, we've seen massive inroads in underwriting to deep subprime consumers while keeping them paying their bills at good rates. So like that's financial inclusion working.
So actually you're seeing more borrowers in the subprime space, not people kind of falling down to subprime, but actually like a growth of borrowers coming up to receiving credit, and that's who may not have before.
That's right. And that's the last part of my rant. And indeed, I'll stop at this, but there's this notion that, because you're bringing in record numbers of deep subprime consumers, but they're doing better than they ever have been before. So the Bureau also has charts where you're looking at basically the number of people that transact. Those numbers are at all-time highs. And then you're looking at the balances that the progress people are paying into their balances. And when the Card Act was first done in 2015, people were basically paying off like 28% of their loans each month. And we celebrated that under Director Cordray. Now they're paying 39% of their loans off each month, right? And so again, like it's that whole kind of Daniel Patrick Moynihan thing where you can have your own opinion, but you can't have your own facts. And that's where we're at right now.
So I'll stop there. Thank you for letting me get that off my chest. No, I like that. It seems like part of maybe your critique is that it wasn't a balanced view, right? So it really focused on fees, deep on that, versus understanding the whole consumer landscape and how each consumer is using the product and the need of the product and how we're better serving.
It's part of that, right? But it's also, even if you're going to focus on fees, stick to objective facts about the fees and how consumers are faring.
I think one of the interesting things that was part of the comments today was that the difference between a rewards versus non-rewards credit card. And I don't know if you heard that, but it was kind of a nuance that could be interpreted as consumers aren't smart enough to choose whether they want the rewards versus maybe having a card with less cost, but no rewards. So that was, I think, an interesting distinction to make, was even not just the fees in general, but the very specific types of cards that are offered to consumers.
So where do you see innovation coming from? Like it seemed like part of his message too was like the government is necessary to drive innovation by creating some more parity or transparency. How do you feel about that?
I struggle with that as well. I think the main thing I would look to, just from the innovation space, and maybe it's just because it's less flashy and people don't talk about it as much. If you think about all the innovations that have taken place in underwriting, folks, and so you see that to double down on this notion of like the deep penetration into the deep subprime space, while ensuring that they're paying off their balances like at better and better rates. Like that requires a lot of like alchemy and data science and risk splitting, and I think it's kind of remarkable, and that's why I really balk when we have policymakers that are kind of then bringing a chainsaw to something that is so delicately created.
Yeah. I think in that, I know you have been both kind of private and public sector, and so kind of leads into Matt's question then, like, how is being on really both sides of that really kind of shape your perspective on kind of regulatory affairs and policy development?
Yeah, I think that, the interesting thing about financial services, so there are kind of two things that drive my personal career. One is, even going as basic as like having grown up a minority in the Deep South, like I have a deep respect for what policy can do to making sure that people are treated fairly, particularly federal policy. So I think that's enormously important, particularly so in financial services. On the other hand, when I was at the Bureau, after we got through that first phase of big regs, I started to see kind of the Bureau kind of move to arguably kind of less impactful things. At the same time, we saw the smartphone changing the world, right? And so I imagine like so many of the guests that you've had on the show like had platforms that were built on or enabled by that one device. And so, I remember sitting at the Bureau thinking, I'll work like another 2 years on another rule that might like move the needle a little bit. Whereas like these people in California are making the pie larger for everyone. They're changing lives. And so just a real recognition that you need the rules and you need to understand them in financial services, but that the only thing that makes the pie larger for people and the only thing that really advances financial health can be product driven.
Yeah.
And so trying to marry the two has been kind of where I've tried to take my career since then.
Well, and maybe describe a little bit for those who aren't as familiar with the CBA and the different committees. Like, what is your role as head of policy? Like, what does that entail on a day-to-day, week-to-week basis?
Sure. So the Consumer Bankers Association is a banking trade group. We focus primarily on retail banks, and increasingly on banks that are $10 billion or more. So banks that are just above like the Durbin threshold, all the way up to the very largest banks. We have, as Matt points out, a wide range of committees in which basically bankers get together and just compare notes in an antitrust compliant way on how the world is changing, right? And so, the example I would use there is during the pandemic, like a lot of people are trying to figure out, like, is it safe to like reopen branches, but then how do we serve our customers, and how do you handle cash? And so we created a new committee that still stands now that helps people compare notes on that and just ensure that there's best practices there. I'm the other side of the house, and that's regulatory change. And so, the goal there is to understand what regulations are coming down the pipeline and how they'll impact the banking industry, and most importantly, banks' ability to serve their consumers. And so we run data, we talk to the Hill, we work with the regulators, and ultimately try to even talk to consumers so that we can help people understand how that regulatory change will impact their lives, and in some cases maybe impact the regulatory change.
I definitely think your background certainly in kind of consumer protection payments. I think payment space, we talked about credit cards a little bit, but just payments in general, not being able to maybe go into branches for people who don't have internet access at home during the pandemic. I think what are you seeing is kind of the evolution of the payments landscape there. I think there's a proliferation of payments providers, and some of it's pretty concentrated still in some of the big banks, but what are some of those key considerations you think about, policy as it relates to payments that would be good for the industry, but also help innovation continue?
It's a great question, Lynn. When I think about payments, I think of it as one example of why silos are so dangerous in regulation. And payments right now, in many ways, are kind of typified by fraud, right? And so that's one of the things that we're all focused on in the banking industry. It's just, and you hear stories. I mean, it's not uncommon to just hear whispers of small institutions saying that credit losses are now rivaling fraud losses because fraud losses are so high. The thing I would note there is that, we have from an advocacy and really a communications issue in this space, because when people think about fraud in this space, there are a lot of concerns, or a lot of people are looking at banks to fix things. And a lot of people are thinking about even reopening long-standing regulations that have governed the payment space since, quite literally, since I was born, because I guess Reg E and the Electronic Funds Transfer Act were done in 78. The concern there is that there's this line in New Jack City, right? This is bigger than Brown, right? And I think a lot of people don't seem to appreciate, particularly people that are folks in the banking sector, that a lot of the problems in this space exist outside the banking space. And so there are things that will involve the telecommunications companies, they'll involve the social media companies, they'll involve other government actors. And so, we're going to have to really work hard in the near future to de-silo all that to be able to start addressing these issues.
So are you able to participate with those groups outside of the CBA or bring some of those in, or how's collaboration going with some of those?
We're working on it. But I think that the thing that's interesting about regs that's kind of different about business is that in the government, there's literally a Reg E Part A person at the Bureau and a Reg E Part B person at the Bureau, and you coexist by not
giving each other a stamp face.
Right. And, and the thing about fraud is it's kind of typified by its ability to arc over. Who would have thought, that telephone companies would be the gateway for security for financial services, right? And so, trying to encourage people to be more open-minded and kind of learn across disciplines is, we're all going to have to learn that together.
Yeah, I think we've certainly seen that. I know some of our attorneys and people in the government affairs space have been at industry events where a lot of the payments processors now are companies like Meta or really what you think of as social media companies, not specifically a payments processor. And I think some of the friction put in even by some of the banks to protect consumers can then make it hard to transact. So finding that balance is certainly hard. Does the CBA get involved in anything related to digital assets or anything crypto, or is that something kind of outside of your space today?
We care about it to the extent that it intersects retail banking, which right now, most of the crypto conversation is more of an asset class or, kind of the background rails. I will say, when I'm a member of, there's a group called the Digital Dollar Project that does some really interesting work thinking about a central bank issued digital currency. And, one of the questions I often raise in those conversations is, what is the need that they're addressing? And the thing to kind of take it back to the advocacy discussion, people will often point to financial inclusion. They'll point to ubiquitous and faster payments. And, I'm stuck thinking, well, gosh, we have a banking system that, we've got record levels of people being banked. We have record levels of subprime card penetration and consumers doing historically well. And I'm, taking my kid on travel overseas and I'm not taking cash because I can take this thing and tap it anywhere in the world and I get points back. Right. And like, we're not talking about that, right? And so one of the things we're realizing as a banking industry is we have to tell our own narrative better, because if we don't, like, people are painting a picture of us if we're not painting that picture for them.
So what are some ways that you're able to do that, being more proactive about?
That's a great question. Some of it is like, as you can tell, I get like really excited talking about this stuff. Some of this is really taking the facts in and educating folks. So if you think about just kind of where we started with the credit card space, like we have a deck where we are going through and saying, okay, here's all the things that our regulators have said that their own data is incorrect about credit cards. And we are taking that to reporters, we're taking that to moderate Democrats on the Hill, and just educating people and just kind of sitting them down and kind of nerding out with them and showing them charts. The thing I would note, I used to say this when I was in government, is that the average American has to hear a song 7 times before they like it, right? And depending on what you think of government, regulators are either better or less than average. And so it takes time, but we're doing that work, trying to pay into building those relationships and trying to earn that trust with folks.
Being received well, or?
I think so. I mean, I think the thing is, and this is the beauty of facts, and this is why I really worry a lot about the future of the CFPB. Like, the data is the data, right? And so if you go in there and you're earnest with folks, I mean, we go in there with some of the most hardcore, like super progressive offices, but like the old heads that like helped write the Card Act, if you sit down with them and you show them the data, like they're the ones that are most willing to engage, because they kind of see the patterns, they see the numbers.
Do you see most of that happening at the federal level, or we're seeing even some activity at the state level in terms of rate exportation or trying to bring control of the banking industry?
It's tricky in the States. Goodness. I mean, we don't do a lot of work at CBA in the state space, but I will note like increasingly everything from state legislation that would impact state tax and interchange to things like fair access requirements. It's just a very tricky space to navigate.
Yeah. I think we've certainly heard that from banks as they kind of crossed that Durbin threshold and then have to pay the interchange fees where before they were exempt from them is a pain point. It sounds like the CBA, many of the bank members are above that, so they're any thoughts about those kind of banks that are kind of right at the edge, like where they it's kind of a little bit above in assets and being subject to those is pretty painful, versus like, do you keep your assets a little bit low and need to do an acquisition to grow, or how are the members thinking about that, about navigating that transition between those two and the lines on the interchange space?
That's a great question. I can't speak to necessarily how the members are thinking about it, but what I would say is that is a great example of how regulations can lead to kind of unnatural, like business practices. I had dinner last night with a group of CFPB alumni, including a fellow that was in the most recent team, and we lovingly got into almost like a Real Housewives, like table flipping argument, because there's this new regulation on open banking, right? And they have this regulation that would kind of dream up this entirely new world that would have, like, they literally have 2 new definitions of consumer, one of which doesn't include natural consumers, right? So it's like a very complex rule set that in many cases, like, they have weirdly specific definitions, and then in other cases, weirdly vague spaces. And I used the Durbin example that you just raised, where I said, look, like, when the Fed and Durbin did that 10 years ago, I think no one anticipated that you would have banks intentionally staying below the number. Like, no one anticipated the rise of these neobanks. Right, like, who wouldn't want to grow, right? And, like, I think no one really thought about the impact, like, that has now been demonstrated on free checking. And so then when you come in and, like, you kind of paint outside the lines of your statute and create all these new rules, just having a little humility to think about, gosh, like, what are the unintended impacts? Like, what are the weird places we might be pushing the market? It's just something that I think regulators have to keep in mind.
Yeah. We push ourselves to, like, test and iterate so fast. Like, do you see that happening in the government again? Like, recognizing where a law maybe was good for a time but needs to be adapted. Is there a faster rate of change, do you think, happening?
I wish, and this is where I really want to have some empathy to regulators. With the increased, like, politicization and polarization that we're seeing. And to some degree, industry, we did a little bit of ourselves. So there was a big lawsuit called Celia Law where we said, hey, CFPB, you have this 5-year term. You should really be appointed by the executive and removable by the executive. But then, like, we then can't really complain then when then, like, the CFPB is, like, more aligned with the executive, and importantly is on a 4-year term. And so, I've done it where, the administration flips, you have 4 years, and then it's just a race to get the regulations done because you're worried. Like, my rule actually got undone by a new Congress because we didn't get out of the gate fast enough. And so, they're just kind of breaking off the mirrors and all the regulatory corners they can to get to the end, but it doesn't lead to great results.
And we've definitely been, I think, kind of hearing and seeing some of that with the regulators, knowing this is an election year. What does make the regulation sticky then? Like, how do you differentiate between, kind of things that are put in place between now and maybe a change of administration, and what can stick, or is really everything up for rescinding if the leadership changes?
Oh gosh, that's a great question. You can teach a whole, and I've even tried to draw out like a law school syllabus. I'm like, if you had a class, I'm like, how do you make a persistent regulatory change? I mean, I think the biggest thing ideally would be to just start with consumer need, right? Start with the data, like where the market actually drives you, and then try to lead to a space where people can serve their customers in a productive manner. I think once you go beyond that to kind of broader designs around the economy and kind of forcing it into unnatural spaces, your regulations necessarily get more brittle.
Is that a consideration as you're going through these? Like, hey, I want this to last forever, or you're just thinking like, here's the problem in front of me, let's solve it and move on to the next thing, or is it somewhere
When you're writing regs, or when you're on our side of it?
Either, yeah.
I mean, ideally, when you're writing regulations, you're thinking about like, how do you kind of get the market in a natural space in a better equilibrium? The one thing under Director Cordray that, I mean, among many things that I thought that was really kind of smart is that he would often look at the industry and say, okay, is the industry getting to a better place on its own, right? And then so where do I then need to nudge, right, or provide clarity to get it there? I think it's when you kind of, again, depart from that it starts to get a little dangerous.
Yeah, and I think with the, we had some folks from the Fair and Responsible Banking Committee on the podcast as well, the chair and vice chair, and I think fairness in lending has been obviously a key topic, and I think particularly with AI. Any thoughts on the executive order of AI last year that came out and was pretty broad and not necessarily industry specific, but I think, how did you message that within the CBA or any feedback from the banks?
Yeah, I mean, I can do better than that. I'll tell you how we messaged it when I was in the government. Like, so when I was at the Fed, I did a speech with Leo Brainerd, who was amazing. And we did a speech in 2017 about kind of where we saw artificial intelligence, where she saw artificial intelligence going in financial services. And one of the things that then Governor Brainerd said was, look, you don't always need to reinvent the wheel. You need to stop and kind of look and see what toolkits you already have, and then see what needs to be, again, to kind of the early point we made, right? Like, what are the incremental fixes you need to make? And in banking, as it turns out, there are a lot of regulations and guidances that apply to the use of artificial intelligence. There's model risk management, there's fair lending, there's guidance on third-party risk management, there's guidance on bringing in new technologies and products. And so there's a lot of great talk and collaboration that needs to happen there, but there's a lot of good tools to start with that you don't need to reinvent. We see the CFPB increasingly leaning in on the use of AI in financial services. So they're calling for whistleblowers. They had a thing today where they're calling for more technologists. The concern that I have is that the CFPB, among other things, was created to basically ensure that consumers get the same protections, whether they're with banks or non-banks. But the Bureau, when they're thinking about AI, really seems focused on big banks, where in many ways, like, there's already like a good framework or tools. Like in the non-bank space, non-banks have no understanding of model risk management because there's no regulator there. They aren't regularly examined for a COA. There's no TPRM guidance, third-party risk management guidance. There isn't this guidance on new products and services. And so, like, I would, like, there's so much good that the Bureau could do if they would just, like, take that framework and start talking to non-banks. It just doesn't seem to be that's they're not putting their chips there, which is a little concerning.
Do you think they're just kind of staying where maybe the, I guess, clientele is more comfortable, that they're not ready to, because I know the CFPB's made some statements and that, if there is a possibility of consumer harm, then they feel like they do have kind of regulatory oversight over that. And they've gone after some non-bank lenders recently. Do you think that they're just not quite ready to jump that far? They're expecting an industry reaction, or what do you think is holding them back from doing that?
The CFPB, for all the reasons we discussed before, is very politically savvy. I'll give you the cynical view and I'll give you the positive view. So the positive view is that consumers, a lot of consumers used to be banks. So if you beat up on a couple of big banks, then you theoretically address a lot of consumers. The more cynical view of that would be, I used to tell this story when I was at Barclays, where there are two pieces of bipartisan legislation at the time that Tim Scott and Sherrod Brown were sponsoring. One was stopping fentanyl, and then the other was taking executive compensation away from big banks. Right, so like I would say, welcome bankers. Like the one area where there's bipartisan support is you and fentanyl.
Yeah.
And
It's not something you want to be long.
right, and so I think the bureau's like smartly realized, and you see this in their messaging, right? Kind of when they started out by saying, "Hey, we're after big banks, not relationship banks," right? You see these carve-outs with overdraft. We see these carve-outs with late fees. Like they've thoughtfully kind of triangulated that if we beat up on this sector, that we're going to basically get a free pass on both sides. And so that's something that, again, like query if that's the best politics. But I mean, setting aside what's fair, because like I gripe, it's my job to gripe, but like who cares about what's fair to banks, right? It's not good for consumers. Like, because if you're a consumer, like you could, Plaid has an update where they say, hey, like more people are using fintech than are using streaming services, right? Like we need the bureau there. Like that's why the bureau exists. And so, I'm hoping that the bureau gets there.
I was reading an interesting article earlier this week that I think I shared internally in our Slack channels, that many people who work for fintechs, if not the majority of people who work for fintechs, actually use a traditional bank for their banking services, though, and have not ported over their kind of day-to-day banking. So I do think that like fintechs have made inroads in a lot of places, but many consumers are still working with the major banks or the regional banks on their standard banking. So what are some of the current, other than, the things we've talked about, credit cards, interchange fees, certainly a lot of complexity and headwinds. Anything else that you see as like current pressing trends, challenges, things you're hearing from the membership that they're worried about, that, what's next on the horizon?
Yeah, I think the thing that I would note is that, we're seeing such a pace of regulatory change in an uncoordinated manner. Like in my limited government career, I've never seen so much change happening from so many different places in a non-talk together way, right? Like at Dodd-Frank, at least there was like one piece of paper that it was all on, like one PDF that you download. In this case, like if you think about like the banker that we've got that's trying to make sure that he or she can provide low-cost checking account services to consumers, right? So this is like a mitzvah, right? Like you're just like low-cost checking accounts for people, and that's like a platform that consumers can build their lives on. They've got a P&L that you're trying to manage down to like the penny. You've got the CFPB coming at you with overdraft regulation that could limit it to anywhere from $3 to $14 under this kind of CFPB set price. At the same time, you have the Federal Reserve coming in, cutting debit interchange rates by a third. You've got Basel rules that would require you to hold capital against this CFPB overdraft credit. And then you've got the CFPB requiring you to create APIs for third parties that you're supposed to pay for free forever. And then this 1034C thing where you're supposed to give away any records to consumers for free, whatever they may ask for. That's kind of this unbounded manner. I just, I don't see how that's sustainable, right? And I don't think, and the worst part about it is I don't think the regulators are like really feel the need to even say, oh, like, what are you doing, Lynn? Like, yeah, like, what are you doing? Like, let's think about like get it all on one page and then think about like what's happening to the consumer.
Do you think that'll lead to more consolidation, more merger and acquisition activity? If the costs of operating get more expensive and you really need that size and scale, it feels like things would, I know that the CBA is primarily the, 10 billion and above banks, but feels like the opportunity for community banks and even smaller banks or ones on that threshold gets even harder.
So, and this is where I can only see problems. I can't see answers right now. We have this weird squeeze, really, I think, on the regional banks, because you've got on the top end you've got prudential regulations that are coming down, right? So you've got these like long-term debt requirements and such that are kind of trickling down to these resolution planning requirements that are coming down to the regional bank level. At the same time, you've got this kind of massive and ultimately like basically prudential regulations saying, hey, make less money on lending, make more money on fees. And then you have consumer regulators coming in and saying, oh, you can't even make a revenue on fees. Like that's a whole thing. It's like a whole other podcast where it's like you've got regulators saying that you can only like recoup your costs on fees, but then they're carving out the smalls, right? And so like for overdraft, for late fees, for Reg II, smalls are going to be carved out. So for those regional banks in the middle, right, you can neither lend nor generate fee income. I don't know what happens to them. And like what if it's, increasingly you're starting to hear even in public earnings calls, executives kind of questioning like Like, do regulators recognize how hard it will be for them to stay in the consumer retail space? And at the same time, you have the CFPB coming out saying, we don't want you to merge. So I don't know what's going to happen there, but it's another good example where if we can, like, please just sit everyone around a table and, like, put it all on one piece of paper, maybe that's a start.
Any speaking of mergers, any hot takes on whether or not the Capital One and Discover merger is going to be approved?
No hot takes.
Say no hot takes.
No hot takes.
No hot
takes at all.
No takes. No takes at all. Yeah, we've learned there's some topics that people won't cover with a microphone here. We won't put you on the spot on predicting or endorsing a candidate either, but anything you see happening in the next 4 years, or you just kind of wait and see.
Oh gosh.
Is it that binary, like you were saying, with the polarization, like it's really that hard to tell where legislation may go or reaction to?
I mean, the thing I would note is that this is unsustainable, right? Like this notion of like a new administration coming in and then you spend all your time kind of throwing out the thing that happened in the last administration. It's not good for the industry, but most importantly, it's just terrible for consumers. And so I don't know what the answers are going to be, but we've got to find some way to kind of come to more middle ground on these issues and to kind of normalize this and get back to the facts.
That's
matter. Like this whole thing, facts
true.
matter. I'd put that on a t-shirt.
Yeah, exactly. I'd buy that.
Yeah.
Thank you very much, Kelvin, for joining us.
Thanks for
great conversation.
I didn't realize how much this is very cathartic.
Yeah. We're here the rest of the day if you want to come back.
It's like a confessional. This is great.